Hey everyone, and welcome back to the channel. Today, we're diving into a topic that's absolutely critical for anyone serious about trading. Yet it's often overlooked by beginners. We're talking about risk management, and specifically, one of the most powerful tools in your arsenal, the stop-loss order. Now, I know what some of you might be thinking. Isn't trading all about making big profits? Well, yes, that's the goal. But the path to consistent profitability isn't paved with just winning trades. It's paved with smart, disciplined decisions that protect your capital. So, you can stay in the game long enough to see those profits materialize? Think of it like this: a professional race car driver doesn't just focus on the accelerator, they're masters of the brakes, too. They know exactly when to slow down to navigate a tricky corner, so they can accelerate out of it safely and powerfully. A stop-loss order is your brake pedal in trading. It's the mechanism that protects you from a catastrophic crash. So, what exactly is a stop-loss order? In the simplest terms, it's a preset order you place with your broker to sell a security when it reaches a certain price. It's your automated exit strategy for a losing trade. Imagine you buy a stock at $50, hoping it will go up to $60, but what if it goes down instead? How much are you willing to lose before you admit the trade isn't working out? Are you going to watch it drop to $40, then $30, hoping it will turn around? This is where emotion takes over, and hope becomes a very expensive trading strategy. A stop-loss order removes that emotional turmoil from the equation. Before you even enter the trade, you decide your pain threshold. You might say, if this stock drops to $48, I'm out. You then place a stop-loss order at $48. If the price hits that level, your broker automatically sells your position, limiting your loss to $2 per share. It's a safety net that you set up before you re in the emotional heat of a losing trade. Now, let's talk about the why. Why is this so non-negotiable for serious traders? The primary reason is capital preservation. Your trading capital is your lifeblood. Without it, you can't trade. A single, large, unchecked loss can wipe out weeks or even months of hard-earned gains. Let's run a quick, sobering bit of math. If you lose 10% of your account, you need to make an 11% gain, unless to get back to even. If you lose 25%, you need a 33% gain. And if you have a devastating 50% loss, you need to double your remaining capital a 100% gain, thus to break even. The deeper the hole you dig, the exponentially harder it is to climb out. Stop-loss orders prevent you from digging that deep hole. They ensure that any single trade represents only a small, manageable risk to your overall portfolio. This is the cornerstone of longevity in the markets. Another huge benefit is psychological freedom. Trading can be incredibly stressful. Watching a position move against you can trigger a flood of emotions: fear, anxiety, regret, and that dangerous little voice telling you to just hold on a little longer. It'll come back. This emotional decision-making is the enemy of good trading. By setting a stop-loss, you've already made the difficult decision when you are calm and rational before you even place the trade. You've defined your maximum acceptable loss. Once it's set, you can step away from the screen with more peace of mind. You're no longer glued to the price chart, agonizing over every tick. You've outsourced the discipline to your trading platform, freeing up your mental energy to focus on finding the next great opportunity, rather than worrying about the last bad one. It turns a potentially emotional event into a simple, logical business transaction. So, the big question is, where do you place your stop-loss? This isn't just about picking a random number or a percentage you feel comfortable with. The most effective stop-loss placements are based on technical analysis on what the chart is telling you. A common and very effective method is to place your stop just below a key support level. Support is a price level where buying pressure has historically stepped in to stop a price from falling further. If you're buying a stock because it's bouncing off a strong support level at, say, $100, it makes logical sense to place your stop loss just below that level, maybe at $99.50. The logic is simple. Your entire reason for entering the trade was based on that support level holding. If it breaks, your trade thesis is invalidated, and it's time to get out. You're letting the market prove your idea wrong, and you're exiting gracefully. Another popular technique involves using moving averages. Moving averages smooth out price action and help you identify the trend. For instance, if you're in an uptrend, you might enter a long trade and place your stop loss just below a key moving average, like the 50-day or the 200-day. These levels often act as dynamic support. As long as the price stays above that moving average, the uptrend is considered intact. If the price breaks decisively below it, it could signal a change in trend, and that's your cue to exit the trade and protect your capital. Other technical indicators, like average true range or ATR, can also be fantastic for setting stops. ATR measures market volatility, using a multiple of the ATR say. Placing your stop to XATR below your entry price allows you to give the trade enough room to breathe and account for the normal daily price fluctuations without getting stopped out prematurely by random noise. The key is to find a method that aligns with your trading strategy and stick to it. Now, I need to address a common fear: getting stopped out only to see the price reverse and shoot up without you. Yes, it happens. It's frustrating, and it's a part of trading. Sometimes the market will dip just low enough to trigger your stop and then immediately reverse. This is often called a stop hunt, but here's the critical mindset shift you need to make. A triggered stop loss is not a failure. It is the system working exactly as designed. It's your insurance policy paying out on a small claim. Think about the alternative. For every one time you get stopped out prematurely, how many times will that same stop loss save you from a 20%, 30%, or even 50% loss? You can't have the protection without accepting the occasional inconvenient payout. The goal of a stop loss isn't to be right on every single trade. It's to ensure your long-term survival and profitability. It's about managing your risk so that your winners are bigger than your losers over time. Let's wrap this up with some practical, actionable rules. Rule number 1. Never, ever enter a trade without knowing exactly where your exit is. That means defining your stop-loss level asterisk before asterisk you click the buy button. Rule number 2. Once your stop-loss is set, don't move it further away from your entry price. It's tempting to give a losing trade a little more room, but that's just emotion talking. You are breaking your own rules and invalidating your initial risk assessment. You can, however, move your stop-loss up to lock in profits. This is called a trailing stop, but never move it down to increase your risk. And finally, rule number 3. Always respect your stop. When it's hit, the trade is over. Accept the small loss as a cost of doing business and move on to the next opportunity with your capital and your mental composure intact. Mastering the use of stop-loss orders is a game changer. It's the moment you transition from a gambler hoping for a lucky break to a disciplined trader managing risk like a professional. It's the single most important habit you can develop to ensure you have a long and successful trading career. So, take this seriously, study your charts, identify those key levels, and make the stop-loss order a non-negotiable part of every single trade you take. Thank you so much for watching today. I hope you found this breakdown on stop losses valuable. If you did, please give this video a thumbs up, and don't forget to subscribe to the channel for more content designed to help you become a smarter, more profitable trader. Hit that notification bell so you don't miss our next video. As always, trade smart, trade safe, and I'll see you in the next one.